Anastasia Amoroso, and this is Beyond 60/40. Today, I speak with the co-head of Morgan Stanley's North America Private Credit, Jeff Levin. Then I sit down with iCapital Managing Director Joe Larizza, who helps answer your question of the month. But first up is our private market pulse. In today's private market pulse snapshot, the one thing I'm focused on is this: the recent trend of broadly syndicated loans, the BSL market, taking market share back from private credit and whether that could continue. Well, first, let's take a step back and take a quick look at how this market share balance evolved over time. Over the past few decades, particularly after the global financial crisis, stricter regulations and capital requirements led to a significant decline in bank lending. As a result, non-bank lenders, which include private credit, stepped in to fill in this gap. Since 1994, bank share of the leveraged loan market went from 72% to around 15% on average in the past 5 years. In the meantime, non-banks have seen their share increase to roughly 85%. But since the start of 2024, the leveraged loan market has experienced a significant uptick in new issuance activity, and the direct lending share has dropped somewhat. For example, looking at the CLO market, collateralized loan obligations, the share of middle market CLOs decreased to 18% as of April of this year, which is down from 23% as of 2023. Now, the surge in new issue activity was led primarily by a wave of companies repricing or refinancing their existing loans, and that represented about 75% that came from these repricing and refinancing transactions. Many of these borrowers turned to the BSL market over private credit. In fact, the first half of 2024 marked the busiest first half on record since at least 2011, with U.S. institutional loan issuance activity approaching a whopping $736 billion. Now, for perspective, that is more than the overall activity throughout all of 2022 and 23 combined. This also meant that some of the existing private credit loans got replaced with broadly syndicated loans. For example, in the first half of this year, roughly $17 billion of loans previously provided by direct lenders were refinanced in the BSL market. And that is a big increase from the just $2 billion that were refinanced in the BSL market in 2023. And in fact, the trend was quite the opposite back then. It's the broadly syndicated loans that were being refied by direct lending. So what drove this surge in public leveraged loan issuance, and will it mean less direct lending going forward? Well, what drove the surge in activity in BSL is the relatively lower level of spreads versus direct lending and the public capital markets that have reopened. For example, private credit loans have historically averaged a spread of 100 to 200 basis points over syndicated loans. That premium shrank in the summer and fall of 2022 when leveraged loan spreads widened out substantially because of macroeconomic uncertainty, and they were much closer back then to direct lending spreads. But since 2023, the gap has normalized once again, making BSL loans cheaper than private credit. However, this dynamic is starting to shift yet again. Private credit lenders have already responded by lowering spreads on new deals. Looking at the distribution of spreads for private credit, for example, you could see that in the second half of 2023, over 81% of new issue direct lending loans had spreads of at least SOFR plus 600 basis points. But at the end of the first half of 2024, that number is only 17%. And as the spreads have decreased, private credit has also managed to win back some market share. Now, looking ahead, we see two other reasons why demand for private credit should remain robust. First, it is the possible further upturn in M&A activity. Indeed, many lenders are beginning to see an uptick in their pipelines, and with a record 30% of private equity-backed funds that are 7 years or older, they are looking to monetize their investments, and they should support deal activity over the coming quarters and therefore the need for financing. Now, second, regardless of pricing, it is also the less tangible attributes of private credit that drive demand for it. The big appeal of private credit for companies is that it often offers borrowers more customized and bespoke financing solutions, and also gives them more flexibility than traditional lenders in terms of payment types, duration, and more. Bottom line, while it is natural for borrowers to shift their preferences based on market conditions, we see plenty of room for both the broadly syndicated loan and direct lending market to coexist and complement each other. And that's your one thing in private markets this week. My first guest today is Jeff Levin, co-head of North America Private Credit at Morgan Stanley and chair of the Direct Lending Investment Committee. With $20 billion in assets under management, Jeff oversees the firm's private credit investment strategy for senior secured loans and junior capital investments in North America. Welcome, Jeff. It's great to see you today.
Thank you for having me.
It's good to be with you. And, I do want to go back to a little bit of your career history. You started at Morgan Stanley, you then went to the Carlyle Group, you returned back to Morgan Stanley. But what's interesting is that you are one of the co-founders of the private credit business in Morgan Stanley. So what do you see back then as an opportunity to launch that at Morgan Stanley, which is a bank, by the way, sometimes competing with private credit companies?
So Morgan Stanley's actually been in alternative investing for well over 30 years. We got into private credit in 2009. A few of us were on the leveraged finance side of the business, on the sell side of the firm within the investment bank. The market's dislocated in the GFC, and to take advantage of that market dislocation, we started the private credit business within our investment management division. And so we raised the capital for our first fund in 2009 and started investing it in 2010. So we've really been in the business for about 14 or 15 years.
Right. And so that was a big opportunity, of course, then to step in post GFC. But you fast forward to today, and Morgan Stanley Private Credit is a great franchise. And at the same time, there's quite a few others that are pursuing private credit strategies. So what differentiates Morgan Stanley in this space?
The two most important facets of the business and strategy as it relates to direct lending is origination and due diligence. And within our direct lending team within the US, we have about 70 people, a meaningful portion of which are originating deals. And that team is covering about 400 private equity firms, which is our primary source of deal flow. That team, though, does work in partnership with the broader Morgan Stanley investment banking ecosystem, where we have hundreds of bankers and thousands of clients, corporates, and private equity firms. So we think that synthetically, we're really getting the benefit within our business of hundreds of people sourcing deals and thousands of clients that can source deal flow into our business, so we can see more, be more selective, ultimately generate better risk return. And then the diligence side of it, but we'll also leverage the Morgan Stanley resources, which could be equity research analysts or fixed income analysts, industry bankers that cover certain sectors, their clients that are C-suite executives, could be economists at the firm, political insights, and so on and so forth. And so there's a lot of intellectual capital and data within Morgan Stanley that we really leverage and monetize through that diligence process.
And when I think about private credit, I think when you were first starting that at 2009, it was a minuscule asset class. Today it's about $1.7 trillion in private credit assets under management, but there's a number of sectors that fit within that. There's direct lending, there's mezzanine, there's others. So what part of private credit are you focused on?
We have $25 billion of capital, $20 billion of which is for direct lending, which is really U.S. sponsor finance. So these are businesses in the U.S. that are owned by private equity firms, and we typically lend at the top of the capital structure, so first lien, senior secured loans. So think of us really as the bank with no one ahead of us. So we have a first lien claim on the assets and the equity of these businesses. Then the other $5 billion of capital that we have is investing in sponsored and non-sponsored deals up and down the capital structure. So there could be first lien that's priced wide to the direct lending market, or it could be second lien or mezzanine or preferred equity.
I saw you mention that you're really looking for down the fairway, high quality returns for your investors. So what does this mean in terms of the return profile you're looking for and the types of companies you do deals with?
The types of businesses that we look for are businesses that operate in sectors that are really non-cyclical. So for example, we'll avoid retail, restaurants, energy companies. We focus on businesses that generate really predictable cash flow streams, have strong management teams, and these businesses generally are really well diversified themselves in terms of diverse customers, diverse suppliers. And within that side of the business, we're really focused on lending money to companies that we have extraordinarily high conviction of getting our money back, providing a very stable NAV and dividend yield for our investors.
But I guess my question to you is, what happens when the Fed, maybe eventually, will actually cut rates? What happens to the return profile of private credit, and how much of the illiquidity premium should investors expect to earn?
Sure. So the illiquidity premium, going back a few decades has generally ranged anywhere between 150 to 300 basis points above the liquid credit comparable, which would be the broadly syndicated loan market. And the spreads on deals right now range anywhere typically between 475 basis points to 550 basis points over SOFR. But I think irrespective of the market environment, somewhere between 150 and 300 basis point premium to the public credit markets is generally what investors should expect from the direct lending first lien product.
So what you see today is about that. So that's fair pricing relative to the expectations.
Yeah, look, I think like any market, certain vintage years are wider than others.
So, but you also brought up the broadly syndicated loan market. And so I do want to talk about that because it seems like in 2022, it was really hard to get a publicly traded leveraged loan, but now that's not the case. And the issuance of lev loans has picked up and CLOs are back as well. So what does this mean for the opportunity set for private credit? Tactically speaking, is it a little bit more difficult to be a private credit investor?
The technical backdrop, which is very favorable for U.S. direct lending, is the fact that the banks don't really do this. So banks, due to regulatory issues, don't lend to middle market companies where the loans don't trade. And so that backdrop means that all that deal flow, which is typically dominated by the private equity ecosystem, comes to private credit managers, managers like ourselves. And the U.S. middle market is absolutely enormous. And so the part of the market that has access to the syndicated loan market is actually a small subset of the opportunity set for private credit, because most middle market companies in the U.S. never have access to the syndicated loan market.
Let's go back to the beginning. And, you've been in private credit space again since the start of 2009. And I imagine you've seen quite the evolution of it. So what has changed in private credit that's most noticeable to you since then?
The scale of the asset class has evolved dramatically. I would compare it to the private equity market, where the private equity market grew dramatically over the last 25 years, and the number of publicly traded companies has been reduced because private equity ownership has become so prevalent. I think the same dynamic has been evolving in the private credit market, where we've seen private credit managers manage far more capital than we did, call it 15 years ago. And so the private credit managers like ourselves can now offer a scaled direct lending product to a large business, provide $1 billion, $2 billion, $3 billion, or even larger loan, and not just close a transaction, but importantly provide growth capital as well. So I do think over time, private credit will continue to grow further and further up market, while always having the opportunity set for the core middle market that doesn't have access to the syndicated loan market.
Right. And one place where private credit is growing quite a bit is within the private wealth channel. And so my last question for you is a little bit about the misconceptions maybe a private wealth investor may have about private credit. And I'll share one that I heard recently while I was on the road. Isn't the volatility profile of private credit lower because private credit doesn't get valued as often as the publicly traded counterparts? What do you say to that? And what do you say generally to a private wealth investor?
The asset class has provided a much more stable NAV in return experience, to your point, than public credit. The reality is, if you look at the data over a 20 or 30 year period, what you'd find is that the default rates are actually lower and the recovery rates are higher than the public credit space. There's 150 to 300 basis point spread premium as well. So investors are getting paid more, I would argue, for taking less risk. So this is not a riskier asset class than public credit. We're getting paid a premium to that asset class because of the illiquidity of the product.
So it's not just the less frequent marks, but it's actually a higher quality profile of some of the private credit transactions. That's the reason for less volatility. Jeff, thanks so much. Thanks for breaking down that question as well as many others about private credit that I know a lot of our viewers had. And thank you also for highlighting what differentiates the Morgan Stanley private credit franchise. Thanks, Jeff, for joining us today.
Thank you for having me.
Today in our Spotlight series, we're answering your question of the month, and I've asked iCapital Managing Director of Data Solutions, Joe Larizza, to join me in the studio to provide his expert insights. Joe, it's great to have you here with us today.
Thank you for having me.
Yes, you've been a leader in the data solution space for a long time throughout your career, and I thought this question would be right up your alley. And it's a common one that we get from our clients, which is how should advisors prioritize when they're considering technology for their financial reporting needs? What do you say to that?
Every financial advisor is different, and they have different client types, and they have different investing needs. So whenever I talk to a financial advisor, I say, really understand what your core competency is and how you want to differentiate yourself. Everything else is a commodity, and you should figure out a way to not have to do it. You really should focus on making really good investments, of course, gathering clients and servicing your clients. And based upon what you're doing, that's where you should invest in technology. So if you're more of a financial planning based advisor, please focus on financial planning tools. On the other hand, if you are more open architecture and invest in more alternatives, you should certainly look at alternative platforms as the priority.
One thing that I think is universal, regardless of what kind of business you conduct, whether it's more alternatives heavy or trading heavy or something else, is the financial reporting function. So what's key to look for when it comes to financial reporting technology for advisors?
You're absolutely right. As the financial advisor, you want to be that financial quarterback. You want to be able to see all of your clients' assets and liabilities. And only once you can see all those can you really truly identify the risks and the opportunities within the portfolio. So the key is to find a tool that can get you there as quickly and as easily, but also timely and accurately, right? So if you have a lot of clients that have multi-generational wealth, where you need to see not just at the family's overall aggregated wealth, but also each individual's, that's very specific that you want to look at. If you have a lot of alternative investments, you want something that could be able to handle capital calls, distributions, and all the different transaction types.
Right. So are we at a place now in this ecosystem where you can get one tool that does all of these different financial reporting things for you, or is it more of a building a service that in turn brings these tools to your disposal?
I think you need to look at the entire ecosystem and figure out a way to stitch them all together. So It may not be a single tool, but you want your tools to talk. And I think that's really the key. But the part that most people overlook is it's not all about the technology. It's about your ability to operate the technology. So you need that educated, dedicated staff that knows how to get the most value at probably what's your biggest operating expense for the firm.
How many technology solutions do you find on average advisors need to integrate and stitch together to deliver that whole suite of capabilities?
Wow, that's a good question. So what we do actually is we take the entire ecosystem and divide it in what we call 15 technology domains. And so if you break it into little pieces, it's a lot easier to look at the technology ecosystem than trying to boil the ocean. So we'll often start by saying, which of these things are important to you? So again, if you're focused on alternatives, let's put most of your time and money there and not necessarily in a trading system.
Well, speaking of alternatives, let's talk a little bit more about how has the reporting technology evolved around alternatives.
Yeah, alts is a great asset class, and it's truly the thing that we see growing the most. When we started our business in 2015, we would find that families had just a few alternatives, and so it was easy to manage. Now we're seeing portfolios where families potentially have 100 positions. And unfortunately, the technology for illiquids has really lagged behind the technology for liquids. So it's still a very manual process to get this information. And many of the families, particularly in the ultra high net worth space, don't have a single financial solution. They may have multiple financial advisors. They're going to have an entire portfolio of alternatives. Maybe they have a group of hard assets, whether it's houses or handbag collections or cars or whatever it is. And they all want to see it in a single place today. And that's been the holy grail that a lot of people haven't been able to deliver. And frankly, if you're the financial advisor that can show them all the insights and risks in the entire portfolio, you're the one that's going to be able to gather the most assets over time. When we talk about insights, to bring it to life, every time there's a crisis, we immediately get a call from a lot of advisors who are trying to figure out, how do I solve this problem? Or we often see it with cash. A lot of people think they're only holding a few percentages in cash, and maybe it's 10 or 15%. And with the market opportunities, that may that may really be able to enhance your portfolio if you know where all that cash is. So.
Right, getting it accurately is definitely crucial. And, you know, my last question for you, of course, Joe, we can't talk about data and technology without talking about artificial intelligence and machine learning. And so what are some of the advances that maybe you're seeing, how we can infuse AI, ML, and make financial reporting more efficient?
We're so excited about what's happening with AI, and I think it's going to be a real change agent for what's going on. So first, it's just in that automation. So back to the point of, it's no longer just 5 assets, it's now tens of thousands of assets and documents. So we're using things like AI document readers to be able to read the information and get it in an accurate and timely way. But what I'm really looking forward to is when it comes to the client reporting side, where it can take the data from alternatives and liquids and synthesize that to not just present data, but also present potential insights that you may not have seen by just looking at a spreadsheet or a very basic chart.
Right. And how close are we to getting those insights?
I'm not sure. I think it's a combination, though, of the technology and people's willing acceptance to adopt that technology.
Well, it's certainly a process and it's an evolution, but sounds like we're making great strides in terms of bringing financial reporting technology to our clients. So, Joe, thank you so much for the work that you do on that, and thanks for joining me in the studio today.
Thank you for having me.
And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are at the top of mind for you and your clients. I'm Anastasia Moroso, and thank you for joining us today. We'll see you next time on Beyond 60/40.